I want to talk to you today about market rate returns. You might be thinking, well, this is going to be boring, or what's there to talk about? Aren't market rate returns a given, like an economic law, the going rate, a responsible benchmark, or just a fair return for the risk? Wait, I can already imagine some of you thinking she wants us to consider concessionary rates of return or being philanthropic with our investments. But that's not what I'm saying at all. I'm talking about an entire reset of our expectations. I want to tell you that market rate returns can be dangerous. Market rate returns are violent. And that's what I want to talk about today. Because market rate sounds neutral, sounds reasonable, but it hides a deep violence. It dictates who gets paid first, who gets left behind, and who gets harmed along the way. For too long, we've been told that market rate is the gold standard, the undeniable benchmark for success, codified into spreadsheets. But let's be honest. These benchmarks are arbitrary. They're historically blind. And most critically, they are morally inert. They were designed for one purpose and one purpose only: to prioritize investor interests above all else. Market rates measure success by capital accumulation, not human flourishing. Yet we build entire institutions to chase these numbers. And what happens when we make those numbers our North Star? Every business decision starts bending towards extraction. We cut safety budgets, suppress wages, outsource risk, externalize pollution, all to meet the expectations of investors. Retail giants like Walmart have institutionalized poverty wages to such a degree that they include public benefit application forms in their new hire packets, effectively shifting their labor costs to taxpayers while maintaining profit margins that enrich shareholders. Hotels and hospitality chains have perfected the art of exploitation, paying less than a sufficient wage while charging ever-increasing fees, asking guests to accept reduced services as, quote, the new normal, and their workers rely on tips to survive. Manufacturing supply chains rely on labor conditions that we would not accept in our own communities, where workers endure 16-hour shifts in unsafe conditions to produce the devices that we use daily and the profits for companies that we invest in. Another recent example that you've probably remember was the train derailment of Norfolk Southern in East Palestine, Ohio. It was a tragedy, yes, but also a chilling case study in the violence of market rate. The pursuit of market-beating returns led to cost-cutting and safety measures, and the result? A community poisoned, lives upended, and environmental disaster. But what happened to the community's stock? To the company's stock? They reported strong earnings, and their stock quickly recovered. The market, in its cold logic, rewarded the extraction, not the responsibility. This is the violence. This is the harm. And often this violence is invisible, normalized by the very language of finance. The phrase market rate returns doesn't define a fair rate. It doesn't push our systems towards social justice. It defines the ceiling of harm that our system allows. Every percentage point above sustainable comes from somewhere: a worker, a watershed, a community. Someone else's margin becomes an investor's profit. But it doesn't have to be this way. We have a choice. We can demand a new framework. In our work, instead of asking, is this market rate or concessionary? Don't even get me started on that term. We ask, does this investment create durable prosperity? Does it account for the cost to people and the planet? I propose we shift our framework. This isn't about doing good alongside making money. It's about fundamentally redefining prosperity. It means sustainable financial health after accounting for the costs of positive and negative impacts. It means internalizing the true costs, not externalizing them. We need to redefine, quote, return to include the well-being of all stakeholders, not just shareholders. And this isn't just idealistic or philanthropic. This is what an economy is supposed to do, at least in my mind. It's supposed to create the world that we want, not just simply the world we get. It isn't a dream, and it doesn't ignore profit, but it enables us all to benefit equitably from our economic system. And there are people at this event that you're at who are reshaping our economy now to do just that. You can talk to Lauren Groton about how mission-driven finance's capital partners provide patient, low-rate capital to diverse emerging fund managers who've been systematically denied access to traditional financing. Or you could talk to Allison Lingain or Melissa Hoover about innovative financing being used to convert businesses to employee ownership. Or you should talk to John Green about helping homeowners shift from extremely predatory contracts for deed to actual equity-building homeownership. So what's our call to action? Let's stop blindly chasing market rate. Let's scrutinize every investment, every decision, and invest with intention, with integrity, and with the unwavering belief that true success is measured not by how efficiently it extracts, but by how well it uplifts. Reshifting our thinking and acting about rates of return is not something nice. It's urgent and critical to building the communities that we want for our kids and our grandkids. So the next time you hear someone talk about market rate returns, I hope you think about the quiet violence that is embedded in that term. Thank you.